Number one, today's webinar represents continuing commitment on Lightspeed's part to trader education efforts, and we're pleased to work with such partners as T3 Live as well as others. As we do with all webinars, we'll be recording today's webinar where you can look at it. After we record it, we archive it on our website. You can check out today's webinar as well as all of our previous webinars on the site www.lightspeed.com/webinars. And by all means, I'd encourage each one of you to go check out what's already there and to go listen and re-listen to today's webinar as well. So today's discussion will be led by Steve Levay and of T3 Live, and just from a compliance perspective, any of the thoughts, notions, strategies, suggestions, and so forth covered in today's webinar do not necessarily represent specific views and or recommendations to buy or sell specific securities or investment strategies. So we encourage everyone to participate actively in today's webinar. You can do so by asking questions as we go through it. Just type them into the webinar chat box, and we'll get to them as appropriate and or at the end. So today's presentation will be about a half hour or so of Steve's slides as he walks you through them, and then we hope to have an active Q&A session after that. So I want to thank everyone again for participating in today's webinar, and I welcome your questions as we go through it. And let's all sit back and learn from Steve Levay. Steve, take us away.
All right, thanks, Peter. Good afternoon, everybody. Welcome to the Intro to Momentum Trading Chart Patterns. I am Steve Levay, one of the head mentors for the Momentum Trading class. And today we're going to talk about chart patterns, my favorite three, how we get in and out, how we stay consistent, how we book our money and move on to the next trade with as little risk as possible. So as we go through here, if you have any questions, like Peter said, just go through and type them in, and he'll show me the questions whenever they deem necessary. So here we go. Enjoy the seminar, guys, and here we go. There's some disclosures. Okay, first thing I'm going to tell you, give you a little bit of introduction about myself. I started trading in August of 2000 when the NASDAQ was still at 4,500. When I started trading, I had no idea about the market. I actually came from a Y2K background, and a friend brought me into trading. Actually, the friend is Mark Sperling, one of the owners of T3. And basically, he thought I was going to be a good fit for trading based on my personality. And lo and behold, 12 years later, I'm still doing this, luckily. I started trading 100 shares of Microsoft, which became very tedious, but it allowed me to start building some sort of routine that I still use to this day. I developed a money-making habit early in my career. I sat next to a guy when I first started, basically watching P&Ls and watching how people traded. I sat behind a guy who lost 6 figures in my first day of watching him. He was buying Broadcom. I think the stock was still $212 at the time. And he kept buying it and buying it. And the next thing I know, I was like, oh, my God, what am I seeing here? But the next day I came back and another guy made 6 figures. So I was just like, oh, my God, I have to figure out how to do this. I have to figure out what I'm going to do. And I have to figure out how I'm going to make money. My first really good trade that I made, I was trading Sun W back in the day when it was over $100. I'll never forget this trade. It was a $121 stock. I bought 300. It was my first really good trade. And I sold it for a $1.50 profit. I made $450 that day, and a guy sitting next to me said, why did you sell it? It's going $3 more. Why would you sell it like that? And I said, look, I just got to make money. It's my best day ever. I just have to learn how to make money, keep it, and move on. And that's exactly what I do to this day. So, the first 5 to 6 months, I just basically was living on a draw, very small draw. I just had gotten married. In trading, you're looking. When I first started, I thought I was going to be a millionaire. So, I was hoping 5 to 6 months in, I'd already be making 7 figures. But obviously, that didn't happen. The market basically cratered when I started. So I had to learn a routine of how to make money. I wondered if it was going to be a good career for me. And again, this was in the first 5 to 6 months as I was training myself. But I loved the job so much, guys. I was committed to taking the train every day from Philly to New York, 2.5-hour commute each way. So, I definitely knew that that's what I wanted to do. So I continued to do it until we opened up an office in Philly, I think in 2002. My second week of trading, I'll just give you a quick example of another unbelievable numbers thing. I don't know how many of you have been trading for as long as me, but there was a stock, Emulex, $123 stock. There was a hoax put on the internet, I guess, and the stock went from 123 to 23 in a matter of minutes. And a guy in the office was buying it all the way down because he was convinced it was a hoax. They halted the stock, and when they reopened it, he was up $750,000. And I just was absolutely stupefied. I thought, oh my God, this is going to be the job for me. And like I said, here I am today 12 years later. Okay, getting consistent. I dug deep and tried to figure out the best way for me to be green every day. I like to be a machine in trading, guys, and when you see the slides that I go through with the flags and everything, you'll understand what I'm talking about. I like to make money. I like to come in every day and beat the market. I consider this a game. How am I going to win the game every day? I focused on keeping my hard-earned profits and ignored all other traders. And again, I'll go back to the Sun W example. I didn't care what anybody said. I was happy. I was paying. Nobody else is paying your bills, so you have to understand that. If you're paying your own bills, you got to figure out how you're going to do that. I began forming my own rules for my style, and I learned to control losses. That's what mattered most to me, not hitting the home runs. I'm what you call a Pete Rose / Tony Gwynn type trader. I hit tons of singles, doubles, and triples. I bat 300 all the time, and the occasional home run. I don't strike out as much, and that sets me apart from a lot of other traders. The turning point that told me I was on the right track, here's a couple of them that I'll give you real quick. My first green month became green quarters and then green years. Once I had my first green month, it became a habit. I studied everything that I did by looking at my journal. I decided right then and there I'm going to repeat everything I did that month. And you know what happens? Like I said, it becomes a habit. And, to this day, I still follow the same routine. I booked profits when I had them. I didn't care about what the stock did when I exit. Again, now that I'm 12 years into it, I don't really know if I actually typify that, because I still get really mad when I sell a stock and then it's $5 higher, or even if it's 80 cents higher. But the bottom line is I'm making money. And that's what everybody has to understand there. The reason we're in the momentum trading business here is to make consistent money, to make cash flow. Okay? And I was totally okay with taking a loss. That's when I knew I was on the right track. Not that I'm always happy about it. Like yesterday I had a bad day. I'm probably negative 4 times a month. And those 4 days, I don't care how much money I'm up for the month, I hate losing money. So again, I consider this, I treat it like a game. I want to beat this market every day. Every day. So now we'll get into the chart patterns, guys. And the first one I want to talk about, bull and bear flags. These are what Mike and I in the momentum trading class talk about all the time. These are the most identifiable patterns, and they're probably the easiest ones to find and make money off of. So I'll just give you a basic definition real quick. Flag patterns are the most basic continuation patterns. These patterns consist of 2 parts, a pull, which you see here, and a flag, or a pennant like you see here. The pull is formed by a sharp increase or decrease, okay? And the flag or pennant forms a move in the form of the price consolidation. So in other words, here's a big move up. We get some movement within this up area here, and you see that in the pennant here. And then on the downside, you get a huge move down, and then it stays on the bottom side of the move for an extended period of time. As you see below, the flag portion of the pattern can take on different shapes. Give you a quick T3 tip, guys. Bull and bear flags can take many shapes and forms. These are the most commonly seen patterns and are a favorite of many traders. I'll tell you right now, in the class that Mike and I teach, this is the #1 pattern that I love to trade. I've made a living off of trading them, and now I'll give you a couple examples on how to find them and how to trade them. Okay. Bull flags. Techno patterns may be found on any time frame. I like to use a 2-minute, a 5-minute, and a daily. Those are the 3 that I consistently use when I'm trading. In the morning for the first half hour, I keep it around a 2-minute, sometimes a 1-minute. And then after the first half hour is built, then I look for my 5-minute trades. And the daily gives me a broader picture of the overall direction I think the stock is going to go. So for the intraday momentum trading, I'm looking at a 2 and a 5. the higher the time frame, the more reliable the pattern. That basically means when you have a 5-minute time frame, you're getting a better description because there's less movement within the bar. When you get a 1-minute bar, you might have an up move 15 cents, a down move 15 cents, but in the 5-minute, you're getting a clearer picture of what it's gonna do. Okay, so in a bull flag, a trader would like to acquire a tier 1 or tier 2. Again, the tier system for most traders is a feeler for tier 1. Tier 5 would be their full position, whatever they can handle if they were to lose money. Whatever they can handle on the downside is their full position. Okay, so you look to acquire a tier 1 or tier 2 near the bottom end of the bull flags consolidation and look to add as it breaks out above higher highs. Okay, a healthy flag will have strong volume on the big move, like you see here in the example, diminishing volume in the flag, and then increasing volume on a breakout to new highs. In this example of PCYC that we see here, here is a perfect example of a flag. This one took on a pennant shape. Okay, you have your big move up. That would be your line right here, your pole. And then what you see is some consolidation over and around this area here. So you've got basically, I mean, I don't have any numbers on here, but I would say that's a good 75-cent flag. Okay, so what you want to do, when it starts building, you see these 3 red bars. The first thing I'm looking at is this red bar, okay? That would be the bottom of the flag here. And again, if you're only looking at this from, let's say, from these red bars, I would say that you probably are probably saying to yourself, you might see this as a bull flag. Let's see what it does. I would look to test right here the second I saw this green bar. So I test right here. A stop would be below this red bar, and this would be my tier 1. Okay, and as the stock started building more bars, I would say to myself, okay, this would be the top of the flag. Whatever price this is, I'm going to look to attack as it breaks out above that price. And as you can see here, it just consolidates for a little while. I never really was tested the bottom of the flag here. So what it does, when it breaks out, boom. So here you have your feeler. It's just sitting in the consolidation mode. Now, if it was to break here, you're losing, in this stock, you're probably losing pennies, okay? The best thing about flags, guys and girls, is your low-risk, high-reward trades. You don't need to get 15,000 shares of this stock to make money. You can buy yourself whatever you're comfortable with, and when it breaks out, you add to your tier, and all of a sudden, boom, look at this breakout. Okay, does everybody understand that? Hopefully you do. Again, if you have questions, please feel free to type them in, and Peter will interrupt me and let me know that I need to answer something. But like I said, this flag is, I love these. I talk about these in our private chat room all the time. When I see this, I'm so excited to see what's going to happen. And guess what? When it broke out right here, never look back, guys. Never looked back. So you probably made yourself, maybe you have a couple hundred shares within this thing, and then you doubled or tripled your position here. Probably made yourself a nice profit on that type of trade. So, again, bull flags and bear flags are my favorite. We'll get into more examples in a second. Give you another T3 tip real quick. The measured move for this pattern is found by simply measuring the distance of the pole and adding that same distance to the lowest point of the flag. Very simple. So, in other words, you're taking the length of the pole, okay, and you're adding the same distance to the lowest point of the flag. So you're adding what's in here, and that should be your measured move. Another way you could define the measured move is to take the bottom of the flag, which would be right about here, and the top of the flag, which would be about here, and you would get your measured move that way. There's many different ways that you can figure these things out, and again, I tell people in our chat room all the time, chart reading is very subjective. What I see does not mean you have to see it the right way. I mean the same way. However, the bottom line is that we all want to make money. How are we going to do it? Okay, so let's move on to the next slide. Here's a couple examples of bear flags. Okay, the same thing, only the opposite. You have a big move down right here. Okay, and this is in the OIHs. You have a huge move down. You have a couple of bars, 1, 2, 3, 4 bars. And let's say this is a, I'm trying to see, this is an hourly chart of the OIHs, guys. You have a 4-hour basic bear flag here. Look what it does when it breaks the bear flag. Gives you that giant whoosh, and then look what it's doing. It's building another bear flag on the bottom here. Okay, so this is a perfect setup on the hourly. And again, the measured move for me would have been the top of this green bar to basically the bottom of the green bar, because you have a couple bars in between. and you still probably you would have cashed in on this trade with very low risk. Okay, and in the next example for the bear flag, you're looking at X, little different shape. It's taking only a couple small bars. It's consolidating in this area on the third bar down. We're looking at what looks to be a 5-minute chart here. And again, look what it does. It consolidates, consolidates, consolidates. When it breaks right here, you have your trade. Okay? Now for me, in a bear flag, a lot of times I like to look at the one of two ways. I'll get out of a bear flag depending on how big the bar is previous to my entry on the chart or how wide the flag is. A lot of times what I'll do, I would probably have gotten short right in this range, with my stop being the top of this bar right here because that's the top of the flag, and I would have added as it broke this double bottom area right here. And it might have even been a triple area looking at it that way. And look what it does. It goes straight down, and then it tries to bounce, tries to test the flag, and goes straight down again. Okay, on a daily chart, the bear flags can take on another form here. Look what it's doing here. So it's still on the down move, but it's flagging a little bit diagonally up, still has not violated any type of area for a significant bounce. So the measured move for the flag here would be from this top here to, I would say, the bottom of this green bar here, and look what it does. Boom. Okay, now the entries and exits for these are very simple again. If I'm shorting this stock, I can do it one of two ways. You have your big move down. Let's start with the OIHs on the left here. You have your big move down. Okay, this bar didn't tried to bounce, didn't. That's a green bar that tried to bounce, didn't give you much. The second bar is a red bar. At that point, I'd be considering short with a stop at the top of this green bar. So really, I have these two bars in place, a double top, okay? And with that being a double top, I know that if it gets through there, I'm probably going to see a bounce, and I don't want to be involved on the short side. But what it does, it consolidates, it's moving, kind of making lower highs in these bars, and boom, you have your drastic move down. So you're probably going to add, and in fact, I always add when it breaks out of the flag, either to the downside or the upside. I probably have a tier 2 or tier 3 position right here, after sitting in it for a couple hours with a tier 1 or 2 right up here. So at that point, I'm taking my money to the down on the down move, and I'm a very happy trader. And again, same things on these. You want to get in as close to the top or bottom of the flag, so you have a little bit of risk on your hands. In other words, the flag tells you guys what you're risking. Okay, if it breaks out of the flag to the wrong side, get out, because the worst thing you can do is hold it because you see the flag, but it breaks the pattern. You don't want to be holding a stock that breaks your pattern. You're getting in for a reason. You're getting out for a reason. So you want to make sure, excuse me, that if a flag breaks the wrong way, you're getting out of your stock. You don't want to get caught, basically, for lack of a better term, you don't want to get caught in your stock and, lose your head. So with that, that's bear flags. Now we're going to talk about symmetrical triangles. These are another one of my favorite patterns. A symmetrical triangle or wedge is a continuation pattern that takes the form of a very tight range constriction. It is a series of higher lows and lower highs that meet to form an apex at which the price range is very tight. This is a continuation pattern that offers very good risk to reward when entered properly. Wedge patterns generally precede an explosive move. The tighter it becomes, the larger the subsequent move. Okay, now, let me just go over that real quick, guys. If you saw a chart with this type of pattern right here, and there wasn't, let's say this was the beginning of the day, and you don't have a huge move in any way on the top or bottom, right? You're looking at this. You're saying to yourself, this is a wedge. It's going to have a move. The only thing is with a wedge you don't know is which way. So right away, let's say the market's weak, and you're looking at Apple here in a wedge, and it had this kind of move the whole day. My thinking is, if the market's weak and it breaks out of this wedge, I'm getting in short. Again, this is a little tougher of a trade. You don't want to load the size up, but you probably put on a tier 2 type trade right here. I love looking for these patterns. The measured move is so easy. It's the top to the bottom of the wedge. The width of the wedge is your measured move. Okay, so that's very simple. I mean, hopefully you guys are writing that down. A wedge will give you a move. You don't know which way it's supposed to go until it breaks out of that pattern. It may go up, it may go down. You want to be on the right side. Again, that example I showed you, let me go back to that bull flag real quick. On this example, okay? The reason it's a bullish wedge is because you had your big move up first, okay? But if you didn't have that move and you just had this wedge, you've got to ask yourself which way the stock is going to go. You don't have a real great clue that it's going to go breaking out to the upside until it broke out with this bar right here. So I hope everybody understands that. It's a great pattern. It does allow you the the flexibility to be a little looser with your wrist because it's a little bit of a wider pattern. The only thing I suggest is when you get into it, if you see that a wedge is building, you just have to make sure you get out when, excuse me, when the stock breaks the price the wrong way. I can't stress that enough. We go over this all the time in our chat room, guys. If a stock is in a pattern that you like and it breaks out of that pattern, there's no reason to be in it. Okay? Let's say it put a big giant red bar down here and you're still holding it long. Okay? You don't want to get stuck doing that. What will happen is maybe it gets back into the wedge and then goes to the upside. Then you can get back in. There is no reason to hold a stock. You know what? I'm in Apple, guys. I know this thing's going up. I know that it's going to 700 when they announced the iPhone 5. I know it might even be an $800 stock, but today it's at 640 because it had a big reversal day, and all of a sudden you're stuck holding it from 670. I mean, you don't want to get into that habit. That's why I say it's very important to learn how to be a strategic and very consistent trader and have a methodology that will make you consistent cash flow over time. And that's what our momentum trading course will do. It will teach you how to think like I do, how to think, that, not robotically, but how to think so that you can make money. You know, I like to tell people 80% of every month. And that's obviously not a guarantee, but I make money mostly every month, 80% of every month. I have very few months where I have more than 4 negative days, and it's just because I'm so habitual and robotic with my trading that's just the way I've always been. So let's go over a couple examples of the symmetrical triangle now. As with all technical patterns, symmetrical triangles may be seen on any time frame and are most reliable on higher time frames such as the 60-minute, daily, or weekly chart. Again, here's that apple on a 10-minute chart right here. Here's a wedge. Now, again, you look at that chart, nobody really knows which way this thing wants to go. But look what it does. It breaks out from the apex of the wedge, and what do you know? It goes straight up. Really without any selling at all until you get to here where it's tailing a little bit too much. Okay, volume should diminish as this pattern forms and should increase when it breaks out, either up or down. The aggressive entry would be to buy the lower trend line in an uptrend and to short the upper trend line in a downtrend. The conservative trader would look to enter on a volume break of the range. Basically, that means as soon as you see this kind of move right here, you're getting in. Okay? The second I see it get through that price, 9 times out of 10 I'm in with at least a feeler, if not more. And again, a feeler for me, might, depending on the stock, size, I guess, could be 100 shares, could be 1,000 shares, depending on the stock. But the T3 tip on the symmetrical triangle, the measured move for this pattern is calculated by measuring the distance of the widest part of the triangle and adding that same distance to the point where the stock broke out from. So again, just like I said, it's the basic move here in Apple would be from the top, which we don't have the price on there, to the bottom, okay? And that's your measured move. Now, I'm going to go over a couple examples of chart patterns that I saw today. The first one I'm going to give you guys, and this was one of our profitable trades in our chat room today, I'm going to give you Qihu, Q-I-H-U. Okay, here's what I saw so far today. You had your big move up, okay, and it broke my channel here, so now it starts printing some red bars, okay? I'm going to get rid of my blue line so I can draw these for you one at a time. Okay, you have your down move, and then from your down move, this is on a 2-minute basis, guys, because this is what I saw on the first. I'll make it bigger so everybody can see. Let's see here. Okay, there it is. Okay, so you have your big down move, and you have 3 subsequent bars that are basically telling me that it's a bear flag. And here's your flag. That's the first thing, okay? It's telling me it's not going up. So I was short around this area right here, okay, with a stop at the top bar. So I'm shorting, say 24.40. and look where the stock goes. Okay, the next bar, once it breaks that flag, went all the way to 23.75. Now, it doesn't look like much. It's a smaller time frame, but the stock could have given you a 60-cent trade at 10.05. And what does it do? It gives you another 3, 4, 5 red bars down, and then what's it do again, gang? It bear flags again, okay? Sets up another bear flag. And then what's it do when it breaks the bear flag? It goes down from 23.65 to 23.20. So that's 2 easy shorts if you just wait and recognize patterns that you can get into, and you would have made 70 cents, let's say 50 cents here, and another 40 cents here. Now, the rest of the day, until, let's see, I'm going to make this a 5-minute just for purposes here. The rest of the day was a little ugly. It started to build a bearish type trade right here to, I'm sorry, my line's off here, to right here, okay? Now, when it broke out of this area right here, you're not looking at it anymore short, guys and girls. This thing is not a short anymore. It broke out of your bearish flag. Even though it's a longer time frame, it's more of a channel. It broke out of its bearish channel to the upside, and thus you don't have a good trade on anymore. I mean, it came back in. I would not be thinking short here. At this point, it's 2:30 on a Thursday afternoon or Wednesday afternoon in the summer. Probably not the best risk-reward scenario for you. So again, if it gets out of your price range and goes higher, please, by all means, get out of the stock, gang. It's just not worth taking any pain. If you were shorting these areas, these concrete, nice-looking bear flags, again, this one, back to the 2-minute because it looks a lot prettier. But if you were shorting here and here off the first half hour or so, you could have made yourself a nice chunk of change. And we did make money, a lot of the people in our chat, off of that Kihu trade. Another one that we were looking at today, I'll give you another example of a bullish area now, is AEO. And let me just put that on the 5-minute. Okay, AEO. Look what this stock did, guys and girls. We have our pole right here. Okay. We have a bullish pattern setting up, wrong line here. A bullish pattern setting up here. Now, the only thing that made me nervous, okay, is right here. You see that red bar in front of my, after my flag? That makes me nervous because it broke out. But, the next couple minutes, look what it does. So in my head, I'm going to redraw my line now, and now my flag's up here. So I have my line here and my flag here, and now my flag goes from basically 22 down to this double bottom here of, let's say, 21.69. So at that point, I'm looking for about a 30-cent move if it breaks out of the highs. And where does it go? It actually went a little higher. It extended more. Okay, look where it goes to. The top here is, without a red bar, the top here is 22.28. So roughly the same as the measured move of the flag there. And another pattern built right here. Again, this is more of a wedge. I mean, you do have these 2 green bars, but as trading goes on, and as you get more comfortable with these patterns, you start seeing them in your sleep. You can pick them out from anywhere. And that's something that, it takes a lot of time to do, but if you can figure it out, and not that you can master it, but if you can find these trades, it will save you a lot of money. It will make you that much more because you're taking low risk and you're making high reward trades. Okay, and I'm going to show you another stock that I've been looking at. I'll give you a daily of it first. Here's PCYC. Okay, now one can make a case for this thing in this range that maybe, you got your obvious huge move right here. Okay. Sorry, let's use a different pen so you guys can see it. Okay, here's your huge move up, right? One can make a case that this bull flagged right there and broke. Okay, so what do you have to do? You have to look at the chart and see what it's doing overall. And what does it do? It comes right down to this area where 1, 2, 3, 4 times it tries to break and can't. So guess what, gang? That becomes your new bull flag area. So now you have a move from 47.68 to 60. So you have a $13 move priced in here, or giving you a measured move. Again, it's not an exact science. It's on a daily. I'm not trading tomorrow thinking PCYC is going to 73. But look what it did. So far, it broke out the top of the flag, hasn't tested the flag again, And right now we closed today at 64 and a half. So, you know, those are some patterns that we like the best. I'm going to try and find one more for you. Let me just find one in LinkedIn or Apple. You know, there's a lot of bullish setups in Apple. Let's look at Apple real quick because that seems to be the stock that people love to trade. Here's what I see in Apple so far for today. Okay? You got your big move up, huge move off the bottom. Okay? Now, right away, at this point off the first 3 bars, I'm kind of thinking this thing might be weak. But what does it do? It gives you a huge momentum turn and then sets up for the next 30 minutes. Bullish, right? So I'm buying right here. What happens? It double tops right there, comes right back into the flag. At that point, maybe I sell the second bar here because it did not touch my flag on this bar, but maybe I sell this one for a small profit. But once it violates and gets back into my flag, I'm done looking at it for that trade. What I'll probably do is revisit it if it breaks out higher. So I'm probably going to buy it now if it breaks out above this area. Even though it's not a flag, I now know where it stopped. So sometimes you get flags that work, sometimes you don't. You know, the only thing you can do is it's trial and error, really. You really have to be in these things to make money. I love the way Apple closed very bullishly here. You know, one can make a case that it is bull flagging for tomorrow. Okay? One could make that case. We'll see what happens come tomorrow. If we look at a daily of Apple, though, it's sitting right near its highs again. If you're a chartist, maybe you look at this and you say, okay, maybe we need about 3 or 4 more days, and we get a nice high-level bull flag up here. Okay, so you want to look at these charts, be as objective as possible. I mean, look, you can see Apple here. Here's where one time the bull flag fails. Here's the flag, right? But what happens the next 2 days? I think this was earnings day right here. Look what it did. Boom. Okay, so things like that do happen, and the flags will fail. The great traders and the really good traders are the ones that lose minimal money when they're wrong, but make as maximum money as they can make when they're right. And again, I will give you a point of advice here. You don't have to hit home runs to be a successful trader. You want to be the person that hits the singles, doubles, and triples, hits the occasional home run, but rarely strikes out. Home run hitters in baseball tend to be unbelievable bashers. They drive in a lot of runs, but they strike out a heck of a lot also. And you don't want to be a person that's going to be striking out. So with that, gang, I have concluded my slideshow. I'm just going to, hopefully you guys have a lot of questions. I'll direct it over to Peter now.
Okay. Thanks, Steve. You know, excellent presentation. Definitely the audience has got a lot of questions. I didn't want to interrupt you while you were going, so I apologize. Some of these questions we'll have to go back to some of the slides there. But,
no problem.
Okay, so let me just take it from the order of how they kind of came in. All right, Steve, are all your tiers the same size? Do you risk the same dollar amount on each tier?
Okay, absolutely. That's a great question. The tier size for me depends on the price of the stock. I am not trading Apple the same way I'm trading, you know, let's just use a $10 stock, whatever a $10 stock is. I will buy, let's say, a tier 5 let's use PCYC. It's a $60 stock. I might buy 2,000 PCYC, but a tier 5 for me might only be 500 Apple, just because I will not risk. I won't put on that kind of risk in an Apple where I feel like I don't have as much control as I do in the cheaper stocks where I can get a little more size and it's not as fast and furious like Apple is. So great question. I try to put my tier sizes based on more of the volatility of the stock and the price of the stock than I do, you know, anything else.
Okay. Okay, here's another question. This is more about your particular type of trading. I have a whole bunch about some of the flags and examples that you showed. But in this particular question, the participant is asking, Steve, what order types do you tend to use more, market or limit orders?
Another great question. I am the type of person who, if I want the stock, I get the stock. So I use a ton of market orders to get in. Excuse me. I will always take offers or hit bids to get my stock, and I will try to use limit orders to get out of the stock. Like if I'm long stock, I'll use limit orders to sell. but if I'm not getting filled, I'm not afraid to hit the bid. I like to get my stock when I want it. I like to sell or cover my stock when I want it. I don't want to be at the market's whim. So I tend to use market keys, probably I'd say 70% and limit orders 30%.
Okay, that's excellent. Okay, so this question, I believe, pertains back to the 2 slides that you were going through flags. And so the question as phrased is, hey, Steve, where did you say the stop was? On the pivot low of a bull flag, basically at its widest point? Can you clarify?
Okay, I'll put the bull flag slide on again, okay? Here's my trade in the bull flag. Or I'm sorry, here's my setup in the bull flag. You have your pull. Your flag has developed, okay? So at this point, I am getting out of this bull flag when it breaks. As this thing is building here, let's say I bought this green bar. Remember I said we have 3 red bars and then a green bar? I'm buying right when this one turns green. I like when I see 3 big bars down and then a green bar here. So I'm buying right here, and I'm risking basically the bottom of this bar. But as the flag is building, if I see a red bar go under this flag, I'm out of the trade. Okay, so when you get into the stock, you want to make sure as your pattern is building, you're following your line as well. Because if right here, I'm up some money. I don't know exactly how much I would have been up here, but the fact is that it's consolidating. I'd probably still be sitting in the trade. And then if it gave me a red bar down here, I would have gotten out. So the first exit will be on your entry. The first exit would be on the previous bar's low. That's what I like to do for these flag patterns. But as it was developing, at that point now, my exit would have been a break of this area right here, which would have taken it out of the bull flag. Hopefully that answers the question. It gets a lot easier as you start studying flags more and more.
Yep. Okay. So another question on flags is the pole made up of 1 bar?
No, the pole can be made up of many bars, gang. And again, let's go back to my charts, and I'll show you where that. Let me find that AEO. Okay. Oops, sorry. AEO. Let's do a 5-minute. Okay, here's the pole on AEO. You have your move, green, 1, 2, 3, 4, 5 bars basically set up the first bull flag. So you draw your pole right here. Okay, there's your pole. And again, it's not an exact science, but you can see how it's somewhat flagging. And again, if we just move this over a little bit now, and you didn't see those bars, all of a sudden this thing looks a lot prettier, right? It looks so much prettier when you have a flag now and nothing after. This thing looks like, all right, if I'm buying this at 21.90, I think this thing's going to explode. My stop at this point would be a low area of this break here, which looks like it would be about 21.80. So in this point, gang, you're risking no more than 10 cents if you bought up here to make what could be, and wound up being at some point, a 50 to 70 cent trade. That's where the low risk comes in. This is the type of trade that I would have gotten in probably a little bit up here, and I probably would have bought a little as these bars, were getting a little bit less. The problem is with this one, it's only 10 cents, so my brain would probably tell me to buy as it broke out of the flag. So as we go here, you see that red bar, I probably would have been in a little here, and then I would have gotten nervous because it broke my flag. So I probably would have hit it out there, but when it revisits, okay, you extend the line here, all of a sudden, I'm probably buying it again at 21.90 and seeing what it does, and then you get your move. So it's not an exact science, but it is something that, let's say, like I said, let's say I hit it out for that 10-cent risk, so I lost 10 cents, but I got back in when it took it out again. I'm more than made up for that trade right there.
Okay. I have a participant who's just asking to clarify where your exit point was on AEO.
AEO, okay. Again, the AEO trade, I'll draw the lines again because I just was trying to keep it neat for you guys. If I didn't know that this stock was going to come down with one silly red bar right there, I would tell you that the flag is built right here, right? Here's your 35 minutes of trading on a 5-minute basis. So here's your top, there's your bottom basically, and here's your pull. Okay? I would have said to you that I'm getting out if it breaks right here. So at this point you're looking at 21.80. Okay, and you're buying it anywhere in this flag. Let's say I'm buying at 21.90. So I'm buying 21.90 with a risk of 10 cents for a measured move At this point, it was a little lower than expected, but if you draw the flag a little differently, again, the measured move here was, I think I said 30 cents, but I think I think that was when I extended the lines a little bit more. So let's put them like this, and let's draw it now from here. Now the flag looks a little different because you have that silly red bar for whatever reason that's sold. Okay, so now you got to move from 21.70 to 21.90. If you get in, you're risking 20 cents now here, but it still gives you that 50-cent explosion up there. So, again, as the day is going on, you have to adjust your entries and exits a little bit. And remember, just because this thing fell 10 cents out of the flag didn't mean the trade was over. You have to just wait until it takes out the top of that bar, the top of the flag, for you to gain your entry. And then you're going to, your exit down here, if it breaks the bottom of this. At that point, if I saw another red bar here, I would have thought the move was over. Luckily, we didn't see another red bar, and the stock gave us about, like I said, 50, 60 cents off the bottom of that red bar.
Okay. Thanks, Steve. By the way, your audience is loving your presentation, getting some tremendous feedback, so it's great. I got a number of questions that are coming in.
Keep them coming, gang.
All right. Okay, so, Steve, on flags, do you only take the breakout of the flag? What about an MA cross within the flag and before it breaks out?
Yeah, I showed you a couple examples. I don't really pay as much attention to the moving averages crosses as other traders do. I basically will buy within a flag and load up more as the flag breaks out. Again, if we go back to the slides, I'll show you the example on the slides. Okay, here's the example on the slide here. I would have probably been in this trade sometime in this area a couple times. I probably would have had whatever amount of size I had here, but I would have loaded up when it broke out. Okay, so I tier up as much as I feel comfortable when I break out of the flag to the upside or downside. I will probably get, no more than a tier 1 until it breaks out, where I'm risking, again, pennies to make a lot of money. And then once it breaks out of that flag, then I know, okay, here's my breakout. I'm loading up at the top. I'm getting out the bottom. And notice how tight this flag is. This is the type of risk reward that's amazing for me, because I could take a tier 5 trade here, and I'm still risking hardly anything. Okay, that's the beauty of this pattern. You can get in and wait for it to break out. I like to get in and feel my way around it as the stock is still building the pattern. And once it breaks out, that's where I load up. I don't think a flag, I put a lot more credence on flags after 10 o'clock, although Kihu gave us a lot of bearishness and bearish setups this morning. I guess when it's earnings season, you definitely will see a lot more in the first half hour than you would if it wasn't earnings season. But I like to put my more flags develop as time goes on. So after the first half hour, that's where I put a lot more concentration under those types of setups.
Okay. So now I'm going to get to a couple of questions that some folks have just about, the criteria that you use for, finding stocks you want to trade. So the questions, I'll combine a couple of them. Hey, Steve, great presentation. I'm just curious, what's the criteria for these types of stock trades? Minimum volume, capitalization, beta, et cetera? And then a related question from another participant is asking, how do you find stocks to put on your watch list? So I'll just combine.
Okay, let's start with the watch list, okay? This was a lesson that we gave yesterday in our chat room. It was a great lesson. And what we talked about is how we game plan. For me, it's very simple. I have a basket of 6 or 7 stocks that I watch every day. And for those of you who follow me on Twitter, I follow LinkedIn, I follow PANW, maybe KYAK, FIO. So I have them all on my baskets. And what I'll do in the morning is I'll come in, I'll look at briefing, I'll look and see what has earnings, I'll look and see what had upgrades, and then I look at the moves that the stocks are having pre-market, and then I look at the charts of those stocks. And what I'll do from there is decide which ones look like they're my best trades and which ones are not. So I set it up so I have A trades and B trades. For me, I always trade LinkedIn. Sometimes it's, A trade. I grade my trades, excuse me. Sometimes LinkedIn is an A trade. Sometimes LinkedIn is a C trade. So I probably put that on the back burner for something else. This morning, Kihu was an A trade. Why? Because it was an earnings trade. I love to trade that stock when it has earnings. And the setup wasn't there, but I knew it was going to be in play. So I like to focus, especially when we're getting into late summer months and we got 2 weeks left of August where it's going to be very dry volume and a lot less herky-jerkiness in the stock, I like to trade the newsworthy plays first, or LinkedIn. If LinkedIn breaks 100 on the downside, I'm going to be all over it short. That would be an A-type setup for me. If LinkedIn breaks out above 110, it's an A-type setup for me. It's going to be on my radar. I always have certain stocks on the radar, and then the rest of them just come in based on news or upgrades, downgrades, etc. Now, the other question that was asked was, what's the criteria? Great question. As far as the criteria goes, I don't really know if there's much in the way of criteria as much as it is the knowledge of the stock. I might see a stock like XYZ, for instance, that has a nice bull flag, but I've never traded it before. I don't know what it's doing. I don't see any volume on it. I do like to trade stocks that have volume, but I don't like to trade stocks that have too much volume. Okay, like LinkedIn, to me, when it trades 2 million shares is fine. When it trades 10 million shares, it's a little bit too much for my brain to take, and that's where sometimes when there's too much volume, I get a little more confused than most. So it's just a matter of sitting back and waiting for a pattern to trade. But overall, excuse me, there's no real criteria for liking a pattern, but I probably won't jump into something if I've never seen the stock before, unless there's a reason to look at it.
Okay. I have one of our participants who's asking, in your trading, Steve, are you trading just stocks? Do you trade options as well? Do you trade them both?
I trade mostly equities, mostly stocks. I dabble in options, but I'm just a basic options guy. Like, I'll buy calls and buy calls and puts and sell calls and puts. I won't do much more. I'm not really good at options yet. I would like to get better at some point, but for now, I'm just an equities guy with a little bit of a feeler, so to speak, in the options world.
Okay. Next question has to do with the technical analysis patterns you've been showing us, which have been great, really helpful. Do you find that these patterns work better or worse with ETFs, SPY, IWM, etc., as opposed to individual stocks?
Another great question. I find that, for me, again, this is just a personal opinion, I don't like to trade the ETFs. The only one I really even bother with are the market ones, like the Qs, the SPYs, and the diamonds. I don't trade the TNAs of the world unless there's really a reason. Like, let's say the 2008 banking crisis, I was all over the SKFs. I was all over what was that one? I forget the other ones that it was. But, very rarely will you see me in an ETF. However, the patterns are patterns. It doesn't matter whether it's an ETF, if it's Apple, Google, Priceline, or a $2 stock. The pattern is a pattern, and if you like it, by all means, just follow your entry and exit rules, and you'll still hopefully you'll make money if you follow the pattern and you follow your rules.
Okay. Next question, the participant is asking you to elaborate a little bit more on when to take profits and how you know when to do that.
Okay. That's a question that, again, we talk about this in our momentum trading chat all the time. When you're happy with your P&L, I always tell people to take off at least 2/3 of your trade. Okay, so in other words, here's your bull flag right here on the screen. I'm probably out of this thing up here somewhere. I'm taking at least 2/3 of my profit just in case I get a red bar back down. I want to make sure I made money in it. So let's just say, for argument's sake, this was Apple, and this was a $3 or $4 move. I took $4 out of this on 3 of my 500 shares. I'm now holding 200 with a stop at break even. So the worst I'm going to do is make the money I made on 300 shares and lose nothing on the 200 shares that I'm holding. Does that make sense to everybody? Hopefully it does. And what I'll do, again, it's a matter of personal comfort. I don't care, again, if this stock went $25 more. If I made, for argument's sake, $3,000 in the trade, by all means, I'm going to take it. And even if I could have made $18,000 in the trade, I don't care. I want to be comfortable with my P&L. I want to be comfortable with the money I made, and that's all there is to it. So I can't really give you a concrete rule that says you have to get out here. If you're happy where your P&L is, take 2/3 off, move your stop to break even, and the worst that you can do is make money. The best you can do is make a lot more money if you're still holding some of your size.
Okay. So I want to assure the audience, I'm getting to the questions as they're coming in. So if you've asked questions in the past couple of minutes, still going to get to them. Just running down the list. All right. So Steve, just this is a question about focus in the morning. You spoke about your time before 10 o'clock and what you're doing and so forth. So question was posed, Steve, is there a limit to how many stocks you're viewing within the first 5 or 10 or 15 minutes in the morning?
Again, I've been doing this for so long. I've been doing this for 12 years, and I still, if you see me with 3 positions traded at one time, that's a lot. I like to really focus on what I'm looking at, and if I'm in LinkedIn and I'm in Apple and I'm in Priceline, I'm going to go nuts. So I like to be in my one trade, let the trade work, and get out. If the trade doesn't work, I move on to the next one. What I do is I juggle the stocks that are on my game plan. The ones that look the best, I get in. You might see me with a couple more positions of 100 shares here, 200 shares there, just to feel my oats and see what the stocks are doing. But overall, if you see me trading, I'm generally talking about 1 or 2 stocks every morning that I'm really looking to attack, rather than trying to trade 50 stocks in a day and holding 5, 10 positions. I think if I look at the VTF right now, I think I traded 5 stocks today total.
Okay. All right, so here's back to some technical questions. Steve, do you like ascending triangle setups that break with volume? They seem to work well also. And do you like consolidation break plays, since risk-reward is very defined and seems to be high probability?
That's a great question. Those are things, again, that we speak about in our private chat. I didn't put them on the webinar here today. I love ascending triangles. I love ascending wedges. I love descending triangles. I love descending wedges. Again, any pattern that you see is good risk reward. You know your entries and you know your exits. That allows you to risk pennies to make dollars. There was a trade today in that Kihu. I think it went to 24.88 for the high, and then it bear flagged on the first pullback. So you missed the 30 cents on the pullback, but then it bear flags. You got in, as the bear flag broke to the downside, you made your 60 cents. So who cares if you missed that first part of it? You still are making money, and you're not risking that much. So yes, I do love those patterns, and we go over them all the time. I look for them all the time. Like I said, anything that will allow me to risk a little to make a lot, I'm all for it.
Okay. Next question is, Steve, how do I recognize support and resistance level when scanning through different stocks? Should I be using higher time frames, like 15 minutes and daily?
Again, it depends on what you're comfortable with. I can find a support and resistance level on a 2-minute chart. I can find one on a daily. I can find one on a 5-minute. Let me just throw up some charts here, and we can go over them real quick. Let's use Apple. Apple, let's see. If you're looking at Apple right now, we know, looking at this chart, this is a 5-minute of Apple, right? We know here's support, okay? My line's not straight, but you got 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 bars that tried to violate downward, so we know there's support here. This would have been a good buy. I didn't buy it, because I was still looking for a short here, but I didn't buy here. But look what it did. It held support and rallied another $10. So it doesn't really matter what time frame you're looking at. You just have to be able to look at the bars, find the tails there, and say to yourself, let me draw my line in here and see if there's actual support or resistance. I don't think the time frame really should make or break your idea for where you find the price point to be.
Okay. All right. The next question is, Steve, with such tight stops, do you find you get stopped out a lot by market makers?
Absolutely, but remember, the one thing that about me, and I guess you guys don't know this if you're not part of our chat, I don't put manual. I do stops mentally. I don't put manual stops. So sometimes, like, again, I'll use that AEO trade because it only broke for a few seconds probably and didn't really move more than 10 cents. I might have still been in this stock. I might not have gotten stopped out, but if this green bar broke lower, I would have definitely been out. So, at this point I got in. I'm probably down 15 cents on this red bar, but I might have been a little bit, if I put a manual stop and the machine tells me to stop, I'm kind of a conspiracy theorist, and I think that market makers can see my stops. So I don't do that unless I'm walking away from my machine. I never put out any stops unless I'm not in front of my computer. If I'm sitting at my computer, it's all mental stops for me. So a lot of times, do I get stopped out? Yes, but I'm quick enough and knowledgeable enough now to get back in. And that's one thing that we talk about as well, in our chat room all the time is I got stopped out. I'm writing a lot of tickets. Well, what we got to do, if you're still making money because you got stopped out, who cares? As long as you're smart enough to get back in and know that the pattern's going to work, it doesn't matter if you got stopped out. You want to win this game, gang. That's the most important thing. You want to beat these market makers. You want to take everything you can from them because they're not upset if you lose money. So make them lose money by beating them every day.
All right, I like that attitude there. Okay, a couple more questions. Steve, if the daily chart shows an uptrend on a 5-minute or 2-minute chart, you see a bear flag, and the stock breaks down, is that when you short the stock?
Repeat that for me?
Sure. If the daily chart shows an uptrend on a 5-minute or 2-minute chart, and you see a bear flag, and the stock breaks down, is that when you short the stock?
I am going to short the stock if it takes out, let's say, let me find a stock that I like to short. I'm trying to see, like LinkedIn, for instance. LinkedIn had an uptrend here, right? If LinkedIn broke this area, I probably would have short. I didn't short it today. I'm just giving you an example. LinkedIn had these 3 bars. If it broke down from here, which looked to be, a little bit of support, I would have gotten short there. I mean, this is somewhat of a bullish setup here. You got, I mean, again, the range is a little wide, but there's your flag, okay, right there in this area. A little uglier than I like, but if it broke that flag, if I was a student enough to be watching this so closely, I probably would have shorted a break of the flag. Maybe made this money, maybe not, but again, I don't care if the stock's in an uptrend or a downtrend. The most important thing is finding my trade based on a pattern within the day's trading. Okay, so if the stock is in an uptrend, I'll definitely make money on the downside. Look at Kihu. Kihu was a perfect example off the bell. A huge uptrend, and if you look at the daily, let's throw the daily up here just so you guys can see Kihu. Look at this move. This thing's coming from about 1450, and today it was closing at 24.58. So it's had a $10 move after earnings and before earnings, right? So in my head, I'm fighting the fact that it's up so much. I'm thinking to myself, at some point this thing's going to pull back a little bit. And then the chart gave you these red bars. Actually, it looks better on a 2-minute, sorry. The chart gave you these red bars. Okay? So even though it's in an uptrend, I got one short here and I got one short here. I hope that answers the question because you want to be able to be very flexible especially in this market where computers tend to run the show a lot. You want to be as flexible as possible to be able to be long when you see to be long when the market tells you to be long, or when the chart tells you to be long, and short when the chart tells you to be short. Even if the stock's up $5, you can still pick off a lot of trades that way.
Okay. Okay, so the next, you spoke before about, you have some trading ideas that you come into the market with and you like to trade them aggressively. And so the audience participant is asking, Steve, where do you get your ideas for which stocks to watch?
Okay, again, I use a couple of websites. I'll just name a couple of them. Briefing, FinViz. When I come in the morning, I look at risers and fallers and see what is up the most, what is down the most, and then I'll look and see why they're at that level. Like I think yesterday, LinkedIn was up $3, and before I even traded it, I had no idea why, so I stayed away from it. And then I found out like around 11 o'clock there was some kind of deal with their numbers that it was going to be better going forward and something like that. So if a stock is up like LinkedIn, even though I trade it every day, I didn't touch it because I had no idea why it was up. And a lot of times, like tomorrow, I'll tell you what, tomorrow, guys, my game plan's already pretty much written. I have LinkedIn on the screen, I have Kihu on the screen, I have Apple on the screen, and I have Kayak on the screen. Why do I have Kayak? Because Kayak had earnings today. Okay, so I'm going to look at that, KYAK. I like the way that stock trades. I like trading IPOs. They're a little thinner and faster than most stocks, but if you're right, they give you the best risk-reward scenario. Now, I'll go over that again in my chat room, and we'll talk about my game plan in the morning with everybody. But it's very important that you make your game plan probably one of your most important jobs of the day, because you can't sit down and just at 9:30 and just, I'm going to buy Apple here, I'm going to buy Priceline, I'm going to buy ISRG or LinkedIn. You have to have a reason to trade, guys and girls, and that's something that a lot of people don't understand. It takes a lot of work to do preparation. I mean, every night before I'm done trading, I write down the stocks that I plan on looking at, or stocks that I made money in today or yesterday, and I write down the highs and lows. So I have LinkedIn, PCYC, Kihu, Apple, PANW, and Kayak on my notebook for tomorrow. And I have the highs and lows written, and with that, I now have my levels that I'm going to trade against, right off the open. And now Kayak had earnings. I think it might be down after hours a little bit. I'm licking my chops to come in tomorrow to trade that stock. I just love the way IPOs trade. It's its first earnings report. It probably gives you some, decent setups during the day, and, we'll make money in them.
Hey, Steve, I'm getting a number of people and very impressive presentation today, and the way you're answering the questions I think is really helping some of our audience by their feedback to me. So a number of folks are asking, hey, Steve, this is great. Do you have a live trade room? Is there any way I could follow you more?
That's a great question, and I have a great answer for you guys and girls. Let me just throw my report up here. Okay. The Momentum Trader course, we are offering a special offer, gang. Mike Lee and I relaunched our Momentum Trader course this August, and it's been awesome. The Momentum course in 1 month in the Momentum Trader mentoring retails for $29.95, but for you guys only, we are offering a special offer. Purchase the course before midnight tomorrow. What's today? Today's Wednesday. Before midnight on Friday, and you will get the Momentum course plus 1 month of mentoring with Mike and I in our private chat for $8.97, which is more than 70% off the retail price. And as you can see, take advantage of this. Go to T3Live.com, click on the Education tab, and then click on the More Info button. You showed initiative tonight by attending this webinar. And I've got to tell you guys, that is something that I want in my room. I want people who really want to learn and really want to become, better traders, and people who become more consistent traders. That's what I would love to have in my room.
Well, that's a very generous offer, Steve, and I hope that the audience follows up on that, because you don't see too many times where experts are going to work with you so closely as Steve and Mike will for the discounted rate that they're offering. So very thankful of that gesture on your part, Steve, and T3s. So if you have time or energy, Steve, I have a few more. If not, I'm sure. Keep going. Okay. All right. So Steve, do you have? Is there in your mind? Is there a minimum low price level that would convince you not to or no longer trade a particular stock that you're following?
Again, these questions are great, guys. I'll use a perfect example. This stock I used to trade religiously every day, and it's MCP. Okay, I made a ton of money in this stock on the move here when it first started being popular. Made a lot of money here, a lot of money here. All this time, it was great. When it finally broke this 30 area, it started getting a little too crazy for me. Now that it's at $9, it's not even on the radar anymore. I'm the type of trader, if I can't make money in a stock, I throw it away. Okay, that's why you don't really hear me all the time talking about Apple. You don't hear me talking about Priceline. I'm not the trader who you're going to make money. If you're following me, you're not going to hear me talk about those stocks, because I don't like Apple, for instance. For me, I will trade on occasion, but it's so fast, and it just has some moves that I don't feel like I have control over how much I want to lose. Yes, I might want to risk $1, but when push comes to shove, it might wind up being $2 or $3. So I feel much safer trading a stock like LinkedIn, where I'm risking 50 cents. I know where my risk reward might be, and it's a very big comfort level for me. The other stock, I'll give you another example that I've been trading all year and then stopped, was B-Vision. Excuse me. Came in 2012. Look what B-Vision did. It went from basically $9 to $55, and then right back down to $9 again. I touched it one time, I think right here, or maybe right here, but I haven't touched it in that range, guys. So when a stock seems to fizzle out and you can't make money in it anymore, that's when it's time to move on and trade something else.
Okay. Okay, so another of our audience is asking, Steve, what's your favorite time frame to use?
My favorite time frame, again, is the first half-hour time frame of the 2 and the 5-minute, or even the 1. I like to use the smaller time frames for the quicker trades in the first half hour, and then I like to use the longer 5. I very rarely will put up a 15, although if I'm looking at a much bigger picture, I might. But during the afternoons, I tend to really put a 5-minute on there and focus on the 5-minute, because in the afternoons, the volume's a lot lighter, and the bigger move probably has happened off the move off the morning. So I like to keep a 5-minute on there to really show me the patterns develop and where my entries and exits. I only like to get in the afternoon when my entries and exits are concrete. So a 1, 2, and 5 are my definite favorites. I obviously have to use it daily for finding where the stock's going to go or where I think the stock could go. But during the day, 1, 2, and 5 are definitely my favorites. Most likely 5 being the number 1.
Okay. All right, so another audience participant is asking, Steve, do you actually draw flag lines on the chart during live trading to help you figure out entries, scaling, exits, and stops?
I do in my chat room. I don't really do it for me per se, but I will, if somebody says to me, hey, Steve, can you show me where you got that AEO at and why, I might put it on there. In my mind, I can kind of see the flag. So I kind of know. The only times I probably will is when it looks like this AEO here, and I really want to know exactly what my entry and exit is going to be. So I might. I mean, I can't say I definitely don't do it all the time. There are times that you will see me do it, but it's not all the time.
Okay. All right, we'll take a couple more. Hey, Steve, how do you factor in the cost of commissions if you are in and out so frequently?
Another great question. Through Lightspeed, and T3, I have a pretty decent commission rate, so I'm not really worried about commissions. Like I said, as long as I'm making money, commissions mean nothing to me. If I'm over trading, then I start worrying. But because I'm so flag conscious and P&L conscious, I really don't care what my commission costs are.
Okay.
I mean, I know that's not the answer that everybody's looking for, but that's just me.
So on a somewhat related note, so I have some folks asking, Steve, what do you use for a trade journal, and what kind of components are you including in your journal?
Okay, for the first 3 years of my career, guys, I wrote in a spiral notebook. I wrote down what most of the time it was only when I had a bad day. And I still do it 12 years later. When I have a bad day, the first thing I write down is what I did wrong. Okay, what I focused on, what I did wrong, why I did wrong. And the funny thing is, a lot of the time, the reason I lose money is because I either got too much size and didn't wait for the pattern to develop, or I got too much size and got stubborn. Those are the only real times that I lose money. And to this day, like I said, 12 years later, I have this notebook with me all the time. I have my stocks written down, and right underneath them, if I have a great trade or a bad trade, I'm just, writing right there. So every day I'll turn the page and I'll look at it and see what's going on.
Okay. I have a number of folks who are asking me to reconfirm that we're recording this webinar, and indeed we are. And in a day or so, it'll be available on our website. Okay, so we'll just take a couple more. Let's see. Okay, Steve, is it common for you just to take profits for just 10 to 15 cents through these strategies?
Sometimes, yes. It depends on the stocks. A more expensive stock like LinkedIn, a lot of times I'm not making 10 to 15 cents. Maybe I'm making 40 to 50. And again, remember, it doesn't matter what you're taking out of it. If let's say I had 3,000 shares of a stock that moved $1, right? But I made 15 cents in it. Am I okay that I took 2,500 for 15 cents? Absolutely. I still made $400, and then obviously I'm only holding a little bit because I sold 2/3 of it, but I'm still holding some for the bigger move. So my brain is basically train gang to take profits and not worry, okay? So as long as I'm adding to my P&L, I really don't care. Again, 10 cents in Apple, yeah, I wouldn't do that. It's not worth it. but maybe 50 cents to $1 an apple, yeah, I'll take that in a heartbeat. But yes, in the cheaper, smaller moving stocks, I find that there are a lot of times that I'm making only 10, 15 cents. But the bigger the stock and the more it's moving, I'm taking more out of it.
Okay. So we have a gentleman who's asking, just to clarify that when you're trading, you're doing so under the pattern day trading rules and or margin in your trading. I assume that's the case.
Wait, say that again?
We have someone who just wants to reconfirm that when you're trading your account, you're doing it on a day trading basis.
Well, I mean, being that we're with T3, I can do it on any real basis, I guess. I'm categorized as a professional day trader, so it's not like if I was on my Ameritrade where I had to, I think there's certain rules if you're trading your own account versus like a broker-dealer account.
Right, and that's basically you have to have a minimum of $25,000 in your account to be a pattern day trader, and or $10,000 to be using margin. So, okay, just wanted to clarify that. Okay, so here's a question. I'm sure you cover this in your class. But, let's see if I can phrase this right. Hey, Steve, I remember watching Mike Lee, T3 Live, once discuss how he trades off the first 3 or 5 minute bar of the day. Can you touch a little bit on that? Thanks, and we love following you on Twitter.
Oh, sure. I can touch on that. That's another one of my favorite setups, guys. And again, we definitely discussed this. I have what's called the 5-minute high or low trade, and I'll show you that real quick with, we'll do Kihu. Okay, here's your 5-minute bar in Kihu off the bell. If you draw your line after the first 5 minutes, there's my line here. Okay, so here's my line. If you're watching Kihu, you bought right here, say 23, what is it, 23.50? If you bought 23.50, guess what? You made some really fast money, gang. That's the 5-minute high trade right here. I bought the high. My stop on this type of move would have probably been the end of the tail there, which I was risking. It looks like no, I'm sorry. What's this price right here? Probably about 23.20. I probably would have given it if it didn't tail there. That would have been, I risked 20 cents, but look what you're making here. And again, the first 5 minutes is a lot harder to define your risk reward, so it's more of a feel type of basis for me, because if I bought the 5-minute high and it failed right away, 9 times out of 10 I'm probably getting out, but if it goes through again, I'm getting in. I hope that makes sense, but in this particular example, this 5-minute high trade worked to perfection because you bought it, you could hold it until you see a red bar, and the first red bar you see is right here. So you could have taken this thing all the way to 24.88 from your entry at 23.50, and you probably would have sold when it broke this low on this red bar, which was 24.34. So you still took out almost $1 in that trade.
Okay. So we'll end with 2 last questions. First question is, Steve, on average, how many trades would you say you do in a day?
Well, now that it's summertime, I don't do that many. When it's really busy, I average from 75,000 to 250,000 shares a day, depending on how busy it is. And the summertime, if I'm lucky if I'm getting to 50,000 shares a day in the summer, guys. I'm taking my money and I'm running. That's just the basic idea of this market. It's summer. Go out, enjoy yourself. It was great today. I was actually up a little bit today, and at lunchtime I went on a nice run, and then I came back and watched the market and prepared for my webinar. So, the morning I like to make my money, sit back in the afternoon, look for the quote-unquote perfect setup, and then, the rest of the day just basically sit and watch, at least for the summertime until it gets busy.
All right. And so we'll end with, so Steve, in looking for patterns only, is it true that you're sometimes trading against overall trends as readily as you're trading with it?
Sometimes that's a good question. Sometimes it is. But again, the only reason I'm looking at patterns is because it defines my risk reward for me. And I'm such a P&L conscious trader that I don't really care what the market's doing. If a pattern is there for me and I know what my out is and I know I'm risking, say, 50 cents to make $3, I'll do that in a heartbeat. Again, if that was LinkedIn, and I'm risking 50 cents, fine. If it's a Kihu and I'm risking 25 cents to make maybe 60 cents, I'll do that too. So it all depends. You know, again, the market was a little weak today, but I bought Kihu here. I did make some money through the 5-minute high trade here, and I actually did not make money on the shorts here, but I know that Mike had made some really good money, and a lot of people in our chat room did on the short side. So again, it's a matter of being flexible and just looking for the overall entries in your trade and just understanding your risk-reward ratio. If you're getting into Apple because it went to 670 yesterday, and you're saying, well, I know it's going to go higher, what are you basing that on? Is there a reason? Is there any type of pattern that tells you you're probably going to have that $12 move that it had today? If you look at Apple, I'll give this to you real quick, guys. This reversal bar kind of scared me yesterday. It had that top of the move at 670.488, and then it went straight down, I think $25, $30. That scared me. I really thought we were going to be down here again at 629, but lo and behold, it is Apple. It's the single greatest stock in the country, and we're almost back at all-time highs again.
All right. Well, Steve, I can't thank you enough for just an awesome presentation. The audience really, really enjoyed it. I think, judging by the questions, that have originated, definitely piqued interest in the concepts you're speaking of. And I'm glad you put that slide back up again, because I think this is an excellent, generous offer that I would highly encourage, everyone listening to take advantage of.
Yeah, guys. Again, if you like what you're hearing right now, it's $897 for 1 month of mentoring, and the Momentum course, including the book that Mike and I have done over the last 6 months. So, if you're interested, definitely get in touch with T3 Live, and hope to see a lot of you in the chat room.
All right. So with that, I'd like to thank the audience, Steve. The comments that are coming in are just awesome. Everyone really enjoyed the presentation, and your give and take on the responsiveness to your questions. Just excellent presentation. Thanks again. And I'd like to thank the audience for their participation. We wouldn't be able to have these webinars without the audience actively participating, and really it's a terrific opportunity to just share wisdom and interact with experts in our industry. So as we opened up our webinar today, I just want to assure everyone that we've archived this webinar. We'll be putting it on our website in a couple of days, and I would definitely encourage you to check out the Lightspeed webinars page on our website for additional webinars that we'll be scheduling in September. As always, our webinars are offered on Wednesdays. They're always free, and they represent just one spoke in the wheel of Lightspeed's continuing commitment to trader education, and we're pleased to work with such partners as T3 Live and all the great folks over there. So with that, I'd like to say thanks to everyone. Thank you, Steve, and we'll see you again.
Peter, and thank you, everyone, as well.
And we'll see everyone on a future webinar. Take care, everyone. Thank you.
Take it easy.